Michelle is an employee earning a salary of $150,000 per annum. She would like to be able to use a new car that has a purchase cost of $35,000 for private purposes. Michelle would like to know whether she should lease the car directly or enter into a salary sacrifice arrangement with her employer. Salary sacrifice allows an employee to exchange some of their future salary entitlements for other benefits paid for by the employer. For instance, an employee might give up part of their salary in exchange for the employer paying for the costs of providing a car. For a salary sacrifice arrangement to be valid, it must be entered into before the services have been performed by the employee. A salary sacrifice arrangement will typically leave an employee financially no worse or better off. This means that the amount of salary sacrificed must not only cover the costs of the employer providing the benefit, but it should also cover any FBT payable by the employer. In general, salary sacrifice will only be worthwhile if the benefits received under the salary sacrifice agreement are not subject to FBT and have no fringe benefits taxable value, or are subject to relatively lenient FBT treatment. Superannuation paid for by the employer is not subject to FBT and is generally fully tax deductible, so it is a common salary sacrifice item. Work phones and laptops that are exempt from FBT can also provide good salary sacrifice benefits, as no FBT is passed on to the employee. The calculation of FBT on car fringe benefits under the statutory formula is often lenient on the taxpayer, and so is another common item to salary sacrifice into. Michelle is considering entering into a salary sacrifice arrangement with her employer to provide her with the use of a new car. Under this proposed arrangement, the novated car lease payments are $800 a month, being $9,600 a year. The running costs of the car are $4,000 a year, and the benefit of any input tax credits claimable by the employer are to be passed on to Michelle. Let's first examine the situation if Michelle funded the car lease directly herself without a salary sacrifice arrangement. We start by calculating Michelle's after-tax salary position, being after income tax and Medicare levy. From this, we can deduct the car lease and operating expenses, and the remainder of Michelle's take-home salary after car expenses. Now, let's examine the situation under the planned salary sacrifice arrangement. Firstly, we calculate the FBT payable by the employer using the statutory method. The taxable value would be the base value of the car multiplied by the applicable statutory rate on the basis that the car is provided for the whole FBT year. The taxable value is grossed up by the Type 1 gross-up factor to calculate the taxable amount. We then apply the FBT rate to calculate the FBT payable. Next, we calculate the input tax credits claimable on the car lease and running costs. The amount salary sacrificed by Michelle would be the car lease costs, car running costs, and the FBT payable. However, the employer's benefit of the input tax credits is then added back. These salary sacrifice amounts effectively adjust Michelle's pre-tax salary. The final step is to calculate Michelle's take-home salary, which is after applying income tax and Medicare levy. We can see that Michelle's take-home salary after car expenses is significantly higher with the salary sacrifice arrangement as compared to paying for the car using after-tax funds. To recap, salary sacrificing can be an effective way for employees to increase their after-tax salary position. However, this will depend on the individual circumstances, including the amount of FBT payable, how input tax credits are treated, and the income tax saved due to entering into such an arrangement. Items that benefit most from salary sacrificing include those that are not subject to FBT, those that have no fringe benefit taxable value, and those that are concessionally taxed fringe benefits.